analyzing multiple candlestick patterns. This segment expands on the information covered in the previous two segments and is designed to further enhance your ability to use candlestick patterns and formations in your technical analysis of the trading markets. Previously, you've learned the basic construction of candlestick charts and how to use single candlestick formations. This section introduces the analysis of multiple formations to your base of knowledge. Understanding how to analyze single candlestick formations can provide important clues to spotting reversals in price action. However, in most cases, a single candle's worth of information is often insufficient to accurately predict the likelihood of those reversals. Candlestick analysis is inherently more reliable when you incorporate multiple candles together in an evaluation of a market or stock's current trend. The patterns listed here are some of the most commonly used and powerful reversal signals and make up the substance of our discussion in this segment. Please note that the information provided in this and all segments relating to candlestick analysis do not constitute a complete explanation of all of the intricacies and details related to candlestick patterns and formations. Our objective in these videos is to provide you with the most important and immediately useful information so you can incorporate this information in your trading as quickly as possible. If you wish to obtain a more complete discussion of candlestick analysis, you can find a large number of books related to this subject through your local bookseller. The bullish engulfing pattern is one of the most important and easy to recognize candlestick patterns you need to become familiar with. This is a strongly bullish signal. Traders usually take this formation as a signal to enter a bullish trade as soon as it appears. Occurring in the context of a downturn in price, the signal candle is an open or bullish candlestick whose body completely exceeds or engulfs the candle before it. The opening price on the signal starts lower than the previous candle and then moves past the previous candle's high price. This suggests strong pressure to the upside coming from buyers looking to take advantage of a cheaper price, and often leads to a near-term rally in price. The chart you now see provides several examples of bullish engulfing formations. Notice that although the signal candle is often very long, it isn't a requirement. The most important component of the bullish engulfing pattern is that the stock have pulled back to a low price, then to experience a positive move in price that completely engulfs the previous day. The first instant indicated on this chart is actually a bullish engulfing pattern using an inverted hammer candlestick as the signal candle. But since the inverted hammer body engulfs the doji pattern prior to it, it qualifies as a bullish engulfing pattern. The run-up in price that follows is good evidence of the strength of the signal. The bearish engulfing pattern is the exact opposite of the bullish engulfing pattern and is equally important and powerful. As a stock stages an upward run, the end of that run is sometimes marked by a sudden shift in momentum as traders take profits or news leads the market to panic and sell off as quickly as possible. If the down candlestick that results is larger than the candle preceding it, you will see a bearish engulfing pattern. This pattern often has a lingering residual effect, forcing the stock in question into a more extended downturn. Traders who follow candlestick analysis generally use this information in one of two ways. They will take profits in any bullish positions they currently have, or they will prepare to short the stock they are watching. This chart provides very clear examples of the bearish engulfing pattern. Notice the significance of the downturns that follow this pattern. This pattern generally comes from a fundamental shift in psychology on the part of the trading community about the affected stock. Instead of being strongly bullish about the strength of the stock's price, new factors, news, or events have now given traders significant doubts. As this chart demonstrates, the effect of this shift can linger for extended periods of time as well as extended price distances. It also isn't uncommon for both time and distance to be affected at the same time. This is why the bearish engulfing pattern is one you should learn to recognize as quickly as possible. Although it is perhaps not as strong as the bullish engulfing pattern, the piercing line is another powerful bullish signal that often leads to early opportunities to profit from a significant increase in price. As with all bullish patterns, the piercing line appears during a downturn in price. After opening lower than the previous candlestick, the market then moves significantly higher. Although unable to exceed the previous candle's high points, the period's momentum is still strong enough to push the price above the midpoint of the previous candle body. In other words, the signal candle pierces the middle line of the candle before it. We can see examples of the piercing line pattern on the chart in front of us. Notice how this signal provides good impetus for the price to continue its bullish movement. Traders consider the midpoint of larger than average up or down candlesticks as important points at which a stock's price could be subjected to significant buying or selling pressure, which provides the logic for this pattern. Since the price managed to pierce and close above the middle line of the preceding candle, traders generally assume that buying momentum will continue to push the price higher in the near term. Aggressive traders can use this pattern as an entry point when it appears, while more conservative traders generally wait to see at least one additional candle period in the same upward direction. The dark cloud cover pattern is very descriptive of the nature of the signal being given, since it warns of significant downside risk. It is also the bearish equivalent of the bullish piercing line pattern. Just as the piercing line provides good opportunities to enter bullish trades, the appearance of a dark cloud cover pattern should act as an early signal to take profit in bullish positions, or to begin considering short positions in the event of a new downturn in price. The construction of the pattern follows the same logic as the piercing line, in reverse. After staging a significant upside rally, the stock opens higher only to drop and close below the midpoint of the previous candle period. Our chart provides good examples of the value and importance of paying attention to the dark cloud cover pattern. The advantage this pattern has over the bearish engulfing pattern is in the fact that the stock doesn't exceed the previous candle's low price before the close. It provides early indication of weakness without sacrificing significant price levels right away. Alert bullish traders can use this formation as an early indication to take profits before a more dramatic profit-draining downturn occurs. Bearish traders can also take advantage of earlier entry points in short trades before the lion's share of the downturn has occurred. The patterns we have covered in this segment are some of the most important patterns that successful traders learn to recognize. Next, we will add 4 additional patterns that you will want to be familiar with as you begin trading.